So we talk about Smoot-Hawley. People throw that around quite a bit, and we just heard Ken talk about it. We'll put up a chart actually that shows going back into the 30s what the average level of tariffs are for the United States. And as we can see from the chart, it really spiked up with Smoot-Hawley. It was a much higher level. You see that's that big spike right there. But if you go off to the right, this is something Goldman Sachs brought to us yesterday. You can see it's way down now. But it starts to inch up. If you put on the $200 billion, you put all the things that President Trump is promising, you start to get back up into the 6, 7, 8% range.
And I think what's critical is to juxtapose this with a chart showing what percentage of global GDP can be attributed to international trade. Back in the 1920s, it was much smaller. And even if we were to go back to the 1960s, it was at the 20 to 25% range. Today, we're at roughly the 58% range. So it would be far more impactful today than it was back then.
And so at what point might we see an effect on global growth effectively?
That's a great question. We're already starting to see small signs in terms of growth. And much of it is anecdotal. It hasn't necessarily shown up in the data. But if we were to look at the Federal Reserve Beige Book, if we were to look at actually the most recent FOMC minutes, what we see are reports back from business contacts in different districts saying they are already starting to scale back or forego business investment as a result of this. Now, again, it hasn't shown up really in the data yet, although we may have seen it show up slightly in the jobs data for large companies, employers over 1,000. We'll have to follow that situation closely. But absolutely, by the end of the year, I think we'll start to see it seep into the official economic data we're looking at.
So how do you then craft a narrative around the trade data from China that we saw today? And on my Bloomberg terminal, you can bring it up, the imports and exports continuing to grow, in particular imports. What's the narrative then of the data starting to show in the soft areas and then sort of the trade data from China overnight?
Well, what I would say is we have to take a step back and realize that we've actually been on a trajectory towards lower tariffs up until really the last year or so. And so we're in a transition period where we're now moving into a higher tariff environment. That means that we could see some aberrations in the data. For example, we might see a demand pull, essentially, buying in advance of tariffs being implemented. So it's very hard to read a lot into this transition period data. But I think what it tells us is, just looking at the trade surpluses, is that's the kind of normal thing you would see between a country like the U.S. and a country like China. And what's really unfortunate, I think, about the administration's approach, the Trump administration's approach to this trade dispute, is that there isn't a prioritization of importance. In other words, intellectual property violations are widely recognized as an area that should be focused on. And if that were prioritized, but instead it's being muddied along with running a trade deficit with a country like China, which is normal and should be expected, and that's part of free trade.